welcome to the Retirement Answer Man Show. My name is Roger Whitney. I'm so glad that you are here with me. This is the show dedicated to helping you not just survive retirement, but to rock retirement. And you know the way that you do that, don't you? It's by focusing on the right things. That can be hard. And taking lots of intentional actions to create a great life. And so that's what we're going to talk about each week. Now, this month in the Retirement Answer Man Show, or on the show, we are in a hard at work mode. And so let's go talk about that with the most amazing coworker ever, Nicole Rockstar Mills. Welcome to week 2 of the Hard at Work October edition of the Retirement Answer Man Show. So what this means is we are going to play classics from the last 4.5 years.
I like how we've self-designated classics.
What is the definition of classic? Is that presumptuous?
Nah, we'll go with it.
I think this one definitely is a classic. So the reason we're doing this is because Nicole, myself, the entire Retirement Answer Man team is hard at work. We're working on all of the show's themes for next year. Imagine that, because we want to create a coordinated effort to give you world-class education. We're working on our Rock Retirement Club retirement course inside the Rock Retirement Club. And 3, we have the Retirement Rodeo Roundup, our first retirement conference exclusively for Rock Retirement Club members. So what we're going to do is share with you these classic episodes. And this one really is a classic.
It's definitely a throwback.
And so a few years ago, Michael Kitces, who's a friend of mine, came on the show and we talked about what is called the rising equity glide path, which is an asset allocation strategy during retirement and how that might fit in managing risk, that sequence of return risk. And what we're going to do is, because Michael Kitces came into the Rock Retirement Club and did a 1-hour live meeting with club members. In 6 Shot Saturday, our weekly email, I'm going to share you a little highlight of that conversation so you can get a feel for what we do inside the club. Because right now we're sort of on a little bit of a member drive-ish type of thing, right, Nicole?
Right. And I just want to mention that club members actually have access to the full replay of the event and all the other events that we do and other guest speakers that come into the club. Yeah,
everything that we do. And in fact, we just had it now. People can listen to all the replays on audio like you listen to a podcast, which is sort of cool. And the reason that we're doing this little mini membership drive is because November 1st, prices to join the club go up. So you can check all that out at rockretirementclub.com. So, Nicole.
Roger.
Yes, it's a throwback, but let's go listen to this classic with Michael Kitces. Well, hello and welcome to the Retirement Answer Man Show. My name is Roger Whitney. I am so glad that you are here with me today to noodle on creating an amazing life and working towards your ideal retirement. Here we are. It's Christmas week. It's the holiday season. It's a crazy week. And what I thought I'd do today is have a very focused show. So we're not going to have the normal segments today. I want to have one conversation. I want you and I to have a conversation with Michael Kitces of the Nerd's Eye View. Michael discovered some research recently and has been digging into it that really flips on its head how you would allocate your investment assets as you move into retirement and as you live out retirement. And I think this is a really important concept, an issue for a lot of us, because normally it's, we think of as we get older, we get more conservative. So we start off retirement as aggressive as possible. And we've talked in the past about how important those first years in retirement are. And the research that Michael has found says maybe that's totally the wrong way to do it. So I want to focus on this conversation. I'm going to have links to all of the articles Michael has written on this research in the show notes. So make sure you go and check those out if this is an important topic to you. Outside of that, I want to thank you so much for listening to the show. Do you know this is episode 98? We are 2 episodes away from 100 episodes. So 100 weeks of noodling on how to create a great life and an ideal retirement. That is just amazing. The engagement and the blessing of having this time to share together every week is pretty cool. Bum, bum, bum. Time for the all-important disclaimer, and that is, I don't know you, I can't give you advice, so don't take advice from me. You'd be silly to. Don't take advice from people that don't know you. Doesn't matter how smart they are. If you want to work with me directly, go to my website, shoot me an email, and we can have a conversation about that. But until then, think of this as helpful hints in education. And before you make any decisions on what you hear here, consult your tax advisor, your legal advisor, your financial advisor, your spiritual advisor, your wife, your husband, somebody that knows something about you. That's just common sense. So let's get to our conversation with Michael Kitces. So Michael, one of the common things that people talk about is like, let's take our age, 100 minus our age, and that's how much we should have in equities. And that's sort of the asset allocation benchmark.
Yeah, like the easy rule of thumb, 100 minus your age. I found for a while there, if you actually look at some of the writings in the industry, there was a point in the 80s and 90s where equities were so great, everyone was getting more better returns. The rule was becoming 110 minus your age and then 120 minus your age. Like the anchor point was creeping up. But yeah, that kind of classic, I don't know, I'll call it conventional view that as you get older, the amount of equities you own declines. And really, like, all 100 minus your age really means is own your age. 100 minus your age in stocks really just means own your age in bonds.
There you go.
So if you're 50, you own 50%. If you're 70, you own 70%. And the bond exposure creeps up. We had to do the X minus when we did 120 minus because of the math. We kind of screwed up the math on it. But yeah, that sort of framework that says as we get older, we're going to own less in equities.
And one thing that's starting to come more in our audience is worrying about another 07, 08. They're worried about running out of money and trying to get to how much risk do I need to take when I'm getting into this withdrawal phase of my life. And intuitively, like, I need to be aggressive, but then I need to get really conservative. So you've highlighted some studies that talk about it's really flipping that around. Can you talk about that and sequence risk and how an equity glide path, I think they call it?
So I think the easiest place to start on this is to actually go right back to this conventional view. The older I get, the more conservative my portfolio gets. I take my equity exposure down over time. So if you think about how this plays out, like it sounds great as a general rule of thumb, but then you think about what happens in real world markets. So I'll kind of overgeneralize a little bit. Like your retirement's basically, so we know markets go up and down, right? So we're going to have bull markets and bear markets. So your retirement's basically going to follow one of two paths. The market's going to go up and then it's going to go down, or the market's going to go down and then it's going to go up. Right? We're going to go up and down, or we're going to go down and up.
And that's really important when we're talking about withdrawals.
But that's important. Like the order of those actually matters because we're taking ongoing distributions. Like this is the key thing that happens when we retire. We're taking money out. So we get this problem that crops up. If you get bad returns and then good returns, that happens to be your sequence. But you're taking distributions out as you go. You're spending money every year. If you get like a horrible decade of returns, frankly, not unlike we saw in the 2000s. If you get or the 70s or the 30s, we've done this a couple of times throughout the past century. If you get a horrible series of returns followed by a good series of returns, you can actually have scenarios where you've taken enough out over time while the portfolio is down that, like, you're completely right that the long-term return is exactly what you're expecting it to be. Unfortunately, you went flat broke halfway through your retirement because you took out so much in the low years, in the low return years, or even negative return years, that by the time the market rebounds, you just don't have enough money left. Either you're completely out, or you're so low that, like, hey, you can get 30% returns a year from here when you've already depleted your portfolio by 80% and you're taking ongoing withdrawals. It's going to go to zero pretty soon. So this sequencing effect starts to matter. If it goes the other way, if I get great returns early on and then terrible returns later, ironically, I find that's what most retirees fear. But when you actually do the math to it, compounding is powerful in both directions. If the first half of your retirement is something like the 80s and 90s, your only problem by the end is going to be whether you die a multimillionaire or a multi-multi-multi-millionaire, depending on how much the market comes down at the end. But you're so far ahead from the good returns compounding for you.
And a lot of it has to do because that timeline compresses that amount of time that you're making withdrawals. If you do it early, you still got 30 years to deal with.
Right. So I have to be really careful of these scenarios where I'm taking ongoing withdrawals and bad stuff happens at the beginning. Now, if I'm only taking a moderate amount, if I'm spending, quote, reasonably off of my portfolio, it's actually okay if the portfolio goes down the early years, right? Because if I think of things like the classic 4% rule, if I'm only taking out a couple percent of my portfolio every year, the reality is, all right, I took out like 4%, but the other 96 is still invested. So I got time for this thing to bounce back. And even over the span of many years, if lousy returns happen for 5 years, I've only spent 20% of my portfolio, but the other 80% is still invested and able to participate in the recovery. So the first way we manage this is just by kind of setting reasonable spending levels in the first place. And the idea that it's okay that markets are volatile in the short term and average out in the long term, as long as I leave enough money in there to actually participate in the subsequent growth.
Okay. And so the normal logic is I need to be in equities early on because I have this inflation risk that I have to deal with. And then later on, I can become more conservative. So can you talk about some of the studies that say really that might not be the best strategy?
So here's the problem that crops up when we start kind of overlaying these two dynamics. So we have this sequence risk thing that says if markets are bad early on and recover later, it's possible that you will have run out of money waiting for the good returns to show up. But the second issue that we get is this asset allocation thing that we said, hey, I'm going to take my equity exposure down as I go through retirement. Because think about how this plays out. So if we get the good sequence, markets go up early on and then they get bad later. This works perfectly. I own more stocks at the beginning and I make extra money. And then we get to the later years and I got conservative. I'm like, perfect transition. But when I get the bad sequence, we actually take a bad problem and make it worse. Because if we get the bad sequence, now we get bad returns early on. We take all the pain because we still got all the equities we're going to own. We're taking ongoing withdrawals. And then when we say, well, don't worry, at least you're getting bad returns in equities right now, but these things recover and average out in the long run. It's like, well, they average out from the long run for everyone else, but not for you because you were taking your equities off the table through your retirement. So by the time the recovery shows up 10 or 15 years out, you've taken so much equity exposure off the table. You took the pain of the losses and you don't participate in the recovery. And it actually gets worse. It makes the situation worse. And even ironically, some of the original 4% withdrawal rules actually showed the 4% rule is actually for a portfolio you regularly rebalance the same equity exposure. Though for the rule for taking equities off the table throughout your retirement, it's not a 4% rule, it's a 3% rule. It's actually worse because of this dynamic, because of this threat that if the sequence turns out to be bad, you make a bad situation worse. And if the market returns end up being good early on, ironically, it actually still doesn't help either because you're not going to fail anyways when the returns are good. Now you're just giving up inheritance. So this sort of decreasing the equity risk throughout your retirement. If things are bad, you make them worse. And if things are good, you just give up the upside.
Oh, that sounds totally.
Yeah, like this is not a good strategy. But
it's the normal thinking about it is getting more conservative as you get older.
It is still the normal thinking about it. And you strictly speaking, I think there is, to be fair, kind of a little bit of a midpoint for this, which is if you're living your retirement in real time, you have a certain goal. Hey, I want to live this retirement lifestyle and do my thing. And markets don't cooperate. Or I should say actually the way. I'm going to try to live my retirement, do my thing. Markets do cooperate. Things are going well. My retirement's going fine. I certainly get the mentality of like, things are going okay. I'm taking some chips off the table. I'm going to dial my equity exposure back a little bit. Technically, if you're up that much, you probably didn't need to, because ironically, the gains you got gave you so much cushion that the future bear markets weren't going to really threaten you anymore. But I get it. I'm certainly not one to criticize anyone for saying good things have happened. I want to take the chips off the table. But when you make this kind of your default strategy, you run the risk that if the sequence is not good, if the first decade is very painful, then you're going to take a bad situation and make it worse. So at least making it a default strategy becomes very problematic.
So when you're thinking about this is really important in my mind, and correct me if I'm wrong, those first 5 or 10 years in retirement are really crucial, because if you happen to go into mediocre returns, you could be screwed. So talk about the idea of being more conservative on the front end and then slowly getting more aggressive so you can protect during that real crucial period of retirement.
Right. So this traditional view, we're going to take equity exposures off the table, often gets called an equity glide path, because the analogy is kind of, think of the airplane coming in for a landing. It kind of glides in slowly, smoothly for a landing. You don't want to come in too sharply, or you're just going to ram into the ground. If you come in too gently, you never actually hit the runway. So there's this sort of gentle glide that you do to coast into the reaching the ground level at the exact point that you want to. That's how investment firms and many mutual funds and managers often implement this decreasing equities through retirement. They call it the glide path. So what we did is we took some research that said, well, what if we turn this around? So we've as we've talked about, the issue with this decreasing equity glide path through retirement is that you start accentuating the problems. If times are good, you give up the upside. And if times are bad, you magnify the downside, because you take the pain early on and you don't get the recovery later. What would happen if we flipped it around and did the opposite? So instead of doing something like, I'm going to start my retirement with 60% in equities, I'm going to finish at 30. What if we just did the reverse? I'm going to start at 30 and I'm actually going to drift up to 60. You kind of presuming I was comfortable with 60 in the first place. I just don't want to take anyone above their comfort level. But like, if you were comfortable at 60, instead of starting there and coming down, what if we actually started more conservative and went back to the target that you were comfortable with? Now, think about how this plays out in sort of our stylized two worlds. If markets go up and then down, this is sort of bad. I'm a little more conservative early on and a little bit more aggressive later. But the reality is bull markets are so powerful when your spending is reasonable in the first place and your wealth starts to compound, that when we ran the numbers of like, if you retire with $1 million and you get a retirement like you started in the early 1980s, so the first 20 years are great because it's the 80s and 90s, and then the last 10 years are horrible because you got the tech crash and the financial crisis. What we see actually happens with a normal rebalanced portfolio and a 4% withdrawal rate, your $1 million turns into $7 million by the end. If you do this sort of rising glide path, you're more conservative early on during the 80s and 90s, and you're more aggressive later during the 2000s. Instead of finishing with $7 million, you finish with $5 million. So granted, it's less. You did give up a bit of upside, but if your biggest problem is like, I only left my kids quintuple my wealth instead of septuple my wealth, we're not exactly creating a retirement catastrophe here. But when we get the other version, what happens if markets are good early on and bad early on and good later? Sort of the classic destruction scenario where I spend down bad markets and then I don't have enough left when the good returns come. Here, this effect where I'm more conservative early on helps tremendously. It simply means you take less pain at the beginning because you're more conservative. You add equities over time. By the time you get to the second half of your retirement and the returns get good, now you've got more equities and you participate even more on the upside. And so you end up mitigating the downside, participating more on the upside. That's fantastic if you're trying to make your money last for your lifetime. And we get a better outcome. And so, as I put it, you kind of get this trade-off effect. So if the sequence is good, all you do is give up extra upside.
Right.
If the sequence is bad, it saves your hide, by being conservative in the early years that are bad and making it up later. So if I don't know how markets are going to go, if I'm not sure if they're going to go up and then down or down then up, and I'm just trying to figure out what to do that's safe, what we find the safer scenario is you actually start a little more conservative and you get a little more aggressive as you go, because you're defending against the bad sequences early and you're only giving up upside if it turns out things were good.
So I imagine to even consider a strategy like this, the first switch in your mindset needs to be, I'm not doing this to make money. I'm doing this to try to sustain a life that I want.
Correct. And as I like to frame this, like this is a, call either a risk minimization strategy or a success maximization strategy. How do I maximize the odds that this retirement goes successful for me at the spending goals that I've got, presuming they're reasonable in the first place? It is not a wealth maximization strategy. Frankly, the wealth maximization strategy is really simple. Put 100% of your money in stocks and let it ride. Most of the time, you just finish with a giant pile of wealth.
Right.
Every now and then, it's a horrific catastrophe. But hey, like if you want to maximize wealth, like, I mean, this is the math too. If you want to maximize wealth, put it all in stocks. Frankly, put it all in like small cap emerging markets and the most aggressive stocks. Let it ride. And most of the time, this is going to go great for you. Now, in the real world, almost no one does that because we're none of us really are like that hardcore of a wealth maximizer. We all are trying to balance out this risk thing to some varying degree. And so as soon as we acknowledge, well, I really want to balance out risk as well, it's like, well, okay, if you're really serious about risk, here's actually an alternative mechanism that works a little bit better as a default.
Now, I can imagine for the softer side of this, one of the issues is if you have that first stylized world of good returns, then go to bad, you have to emotionally accept that you're at the party, you get to have one cocktail, but you're not going to be having as much fun as everybody else. And psychologically, that's really hard, right?
Yeah, it is, again, with the caveat that, you know, again, I mean, we can kind of run these numbers and see what it looks like in these good scenarios. And truly, like if you retired in 1982 and you did this, you would have finished with $7 million. You only finished with $5 million if you started with one. That, like, you're not giving up that many cocktails. Like, you. I mean,
but when you're at
like,
the party,
it cost you $2 million, but you still made an extra $5. Like, it's. You know, I mean, we just sometimes don't appreciate how like dramatically powerful bull markets really are. I mean, you're absolutely true. Like I could look at this and say, what a freaking catastrophe. I heard about this strategy where if I get a bull market, I finish with 2 million less and I only started with one. Like that's horrific. It's like, well, okay, but only because you would have finished with 7 and you finished with 5 million. If you started with one, that's pretty darn amazing. Or if you started with 100 grand, 7 or 500,000, the number.
Oh, I totally agree with you. It's just
like
when you zoom down, it's that emotional behavioral thing that of they're having fun and I'm not having as much fun.
Yeah, well, and I absolutely, and I mean we see this with folks that we work with as well. And frankly, this kind of happens at any age and point. I mean, I've also had clients who are 80 years old who were supposed to do the like decrease thing as they go, but they're 82 years old now. And they're like, well, my 82-year-old suite mate at the nursing home made 27% last year. Why isn't my portfolio doing this? I'm like, you're hardly even spending your money now. Like this has no actual impact on your lifestyle. Like, why are we freaked out about this in a world where it didn't impact us because you've already succeeded in all the spending goals that you wanted? So, I mean, certainly there's an effect here. I mean, at any point we decrease our equities, whether you do it early in retirement or late in retirement. If you're going to get a raging bull market, you're going to leave some upside on the table. That's the trade-off for managing the risk. But if you're really trying to manage the risk and you really are concerned about not running out of money, it still comes back to the fundamental point that it's actually better to take some risk off the table early than take some risk off the table later, because taking risk off the table later may be too late to solve the problem.
Now, you highlighted this research about 3-4 years ago. In 12 and 13, I believe. I have not heard much about it outside of you highlighting this research from a planning standpoint. Any Any thoughts of why that is and whether this is really being accepted yet?
I think it's still kind of percolating out there in practice. We've had a couple asset management firms that have reached out and are just kind of asking about it and talking about it. We actually had contact from, I guess, in deference to them, I'll leave them nameless, one rather large asset manager that does target date funds, kind of the traditional glide path coming down, who contacts us and said, we were actually finding the same thing in our research internally as well. We hadn't figured out what to do with it yet either. And because I think the challenge they're having that everyone actually has with this, at least initially, is it sounds so unfamiliar that they're like, yeah, but do I really want to do that, right? Like just this whole idea of, to get more conservative early in retirement, but do I really want to do that? And frankly, I think it's probably, the adoption of it has probably been further slowed by the fact that rates are just so low right now. Like the trade-off, right? If we're going to own less in stocks, we're going to own more in bonds. Bonds have some A, miserable returns, and B, a lot of concerns about what happens in rising rates. And so I think there have been a lot of people that have been afraid to adopt this kind of strategy because essentially they're afraid of some combination of low bond returns, low bond yields, and rising rates. Now, as we've shown in some of the follow-up research on this, it still works. In fact, it when we run this through scenarios like the 1970s, the worst bond bear market of the past decade, inflation went from basically 2 to 12 from the mid 60s to the early 80s. Bonds got slammed all the way through this. It still worked drastically better to implement the strategy this way. And the reason actually is really quite simple. If we're trying to deal with risk and bad things happening, bad things in bonds are still way better than bad things in stocks. Bad stock market was 73, 74. You lost 45% in about 2 years. Bad bear market in bonds, the worst you did in any particular year in intermediate government bonds, you lost about 1. Maybe 2. You would short-term price movements would move down, but you're still clipping a bond yield that helps to make you up by the end of the year. So, in a world where stocks can go down 45% in a bear market in short time, and the worst bond bear market of the century gave you a return of -1 on an intermediate government bond fund, if you're trying to dodge the -1 to buy things that can go -45, this is like you're jumping out of a frying pan into a fire.
So that's why it still works.
Kind of scenario. That's why it still works. You're not doing this because you're trying to get return out of bonds. Again, this isn't a wealth maximization strategy. We're not trying to max the returns. You want to max the returns, put it all in, high volatility stocks and let it ride. We're doing this because we're trying to manage risk. And so if we're trying to manage risk, you can think of it this way. I don't actually need 70% of my portfolio to make any money to actually have a successful retirement. As long as the other 30 or so that's invested in stocks does okay, and I dollar cost average into stocks a little bit more through the first half of my retirement, so I got a little bit more stocks for the second half. And I think that's actually even an alternative way to view it. Think of it this way. I'm going to own about 30% in stocks to cover my retirement. I'm going to buy a little more in the first half of my retirement to dollar cost average into stocks for the second half of my retirement. And the rest is just my bond bulwark. Its primary job is just to defend capital. And if I can clip a little yield along the way, that's great too. Yields are low right now, but so is inflation. Obviously, they move in tandem. And so that's why we actually find it's not nearly as destructive as people make it out to be, to have a bunch of bonds. You're certainly not going to make a giant portfolio out of it. Like I don't want to say bond returns are great because they're certainly not. But if you're trying to maximize success, not maximize wealth, the maximizing success is still about being very careful about how much exposure you have to stocks. That's really where the catastrophes can happen. It's where the upside happens, but that's where the catastrophes can happen. And, buying low yielding bonds to avoid potential stock catastrophes is still a healthy trade-off. Can't do it too much because 100% bonds has other problems, but doing more bonds and less stocks is not a bad thing.
Yeah. And the key phrase you said there, and that's a great way to close, is thinking of a strategy like this is about maximizing success of your life in retirement, not wealth. And you have to accept that to even consider a strategy like this.
Yeah, I mean, it's really true. Like, this is still ultimately about, if you're sitting there and saying, I just want to make sure I don't run out of money. I'd like to enjoy a little bit of upside as well, but I really want to make sure I don't run out of money. This is a good fit for you. If your primary concern is, I really want to make more money, I really want to get more return, I want to figure out how to get more out of my portfolio, this is just going to leave upside on the table.
All right, well, I'm going to have links to all of the articles that Michael has written on this research so we can start to dive into this. And we're going to revisit this because I think this is an extremely important topic on how you allocate your assets in retirement. If you were indeed focused on having confidence of achieving our life goals and not simply wealth maximization, I think that's a big key distinction that I took from this conversation. So I'll have links to those in the show notes at rogerwhitney.com. I want to thank you so much for spending this time with me, noodling on how to create an ideal life. I appreciate you so much. I hope you have a wonderful holiday season and a very Merry Christmas.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.